Hey everyone, and welcome back to another portfolio update. So in the last week, the couch investing portfolio was up 1.41%, whereas the S&P 500 was up only 0.21%. Year to date, we are still underperforming, but no, not by much. We're down just over 5%, whereas the S&P 500 is down 3.77%. Since the start of the portfolio, we are kicking the S&Ps behind. We are up 51.65%, whereas the S&P 500 is up 13.53%. And so in today's video, I want to touch on a couple of comments that were made by the Fed, by Tom Lee, a very important lesson by Warren Buffett, and then touch a little bit on the Google whiz acquisition. I probably have already a video on the channel talking about the synergies, the pros and cons of that acquisition. So if you missed that, that will be in the top right corner. We really appreciate that. Definitely check out FinChat's link down in the description. You get 15% off. And if you're a new user, you get 2 weeks for free of FinChat Pro. So do check them out. I'll start off by giving a short overview of what's going on with the portfolio. As you can see, nothing much. Nothing is going on. Nothing has changed. I didn't buy anything. Well, I actually, that's a lie. I bought one share of NVIDIA during the live stream during the GTC event. Why? Just because. I have it here, good for tracking, but that's about it. Am I going to increase that position? Probably not. Probably not. I am still thinking about opening up a position in Nebius. Like I said, I still have to wait around a week to get more cash in the portfolio, and then I'll probably open up a position in Nebius. Hopefully it doesn't go up much in the next coming days. And then I've been thinking about the bottom 4 positions, whether I should keep him just for the sake of keeping them or consolidate into the other existing positions, or maybe use that cash to open a position in a Nebius, for example. Right now, as you can see, I am down 7.6% on my Disney position, down 25% on the Celsius one, 37% on Accelera, and 4.2% on Owlet. Of course, these last 2 positions here are nothing. This is a position worth $1,000, and this is just over $2,000 or something like that. So yeah, very, very small position in the portfolio, 1.3% and 0.5%. So yeah, I only opened those positions because of the potential 10x or 5x in the future, if that's going to happen. And at least if it goes down, it doesn't really hurt the portfolio that much. Same thing here with a Celsius, for example, although that was a bit larger. It's down 25%, so now it's smaller. But that was basically the idea behind these smaller positions. It's a lot of upside and yeah, maybe a lot of risk as well. But if we go to the downside, at least it won't hurt the performance of the overall portfolio. And actually, as you can see, didn't really hurt it much, right? We're still up 51% since the start of this journey. We did get hit, by the way, on Friday, 8% for Micron. So that did change the performance of the week a little bit. I could have outperformed a bit more, but I'm still up 3.8% for Micron. And as I said, once I have cash, I will be adding more to Micron if it stays like this under $100, because in my opinion, good quarter, good comments as well, overreaction by the stock market, and I'll take that opportunity to add a little bit more. All the rest here, very happy. I mean, happy. Could be happier, of course, but I'm not complaining. I'm not complaining about the performance of the stocks in the portfolio. And I know what some will say, oh, you're again changing some of the stocks in your portfolio. You're a trader, not an investor. No, a trader trades multiple times a day. I'm an investor, and sometimes I will make changes to the portfolio, and I'll explain why. Actually, I'll let Warren Buffett explain why, and then I'll just add a little bit more information. But let's first start off with a couple of comments from Tom Lee. So right now, I don't know what the title of this video is going to be, but probably something like Recession Cancelled or something like that. So what does he show here? The 20 fastest market corrections from their 52-week highs. Number 1 is the one during COVID, at the start of COVID, 8 days, that's about it. Then we've got the previous trade war back in 2018. Then we've got the Eisenhower heart attack, we've got the Vietnam War, and then 5th fastest is the one we are at right now. Believe it or not. Yeah, believe it or not, you can put what we're having right now in between all of these 10 times or maybe 50 times worse event. Yeah, a pandemic, trade war, okay, maybe that one wasn't really that the end of the world. Eisenhower heart attack, Korea War, Volcker shock, Asian financial crisis. That's quite a strange name if we're being honest here. But okay, what you're seeing afterwards is what happens after these fast 10% correction. So only COVID, that's the only one that was still down 1 month later. But afterwards, 3 months later, 6 months later, 12 months later, you can see that most of them, all of them actually, are up. And on average, 1 month later, on average, if you look at the average here, 2.9%. 3 months later, up 8.2%. 6 months later, up 15%. And then a year later, close to 20%. So again, if you think there is a recession, fine, then you think there is a recession. The data doesn't show me any recession anytime soon, although there's always a chance, 1 in 4 chance, I think, that there is a recession. That's always been the talk. So 1 in 4, there is a recession. Okay, if you're always going to say, oh, there might be a recession, there might be this, then you will never be invested. Let's be honest. And as I've said, and as I showed you in the past, if you look at past recessions, past events, past recessions especially, the stock market has always, I think always, rebounded before a recession is over. So the stock market bottoms before a recession is over. Now, he even showed us something much worse, 100 times worse, and that's the Cuban Missile Crisis. Basically, they were because I wasn't born in 62, believe it or not. Well, they were quite close to nuclear war. And look at this. This was the whole period. And look at what has happened here. The market rebounded before this whole story ended. Of course, it didn't recover all of its losses, but almost. And the market rebounds when there was still a threat of nuclear war. So what's to say we haven't rebounded from a potential threat of a recession? I think that's a possibility. Moving on to some data here. So currently the probabilities of a rate cut during the next meeting, so in May, 14.3%. So 85.7% chance that we're staying where we are right now, which I think that's going to stay the same. The one in June has a 67.3% chance of a rate cut, 25 basis points. And then the one in July, a 46.7% chance that we are still staying at the same levels that we will be in June if we cut. Or there is a 36.4% chance that we have another cut. And then if we look at the September meeting, that's a bit higher already, 43.2% that we'll have already 2 cuts. At the moment, the Fed still thinks we're going to have 2 cuts for the whole of 2025. And remember, like we've said in, I think, a month or so ago, the longer you have this cutting cycle, the longer you can stretch a bull market. Of course, if you will have to cut, if they will force you to cut because we are going into a recession, an extreme recession, yeah, okay, then maybe that's not the best case scenario. But if we are still going to have the same economy as today, not going into a recession, having a small slowdown, and you can stretch those cuts in, 2 cuts this year, maybe 3 cuts this year, another 2 cuts next year or so. If you can stretch that, then you can stretch the bull market as well. Moving on to some comments from Jerome Powell and some Fed policy information that we got. So the Fed fund rates didn't really move. The Fed will slow the pace of Treasury balance sheet runoff, passive QT, from 25 billion to 5 billion per month, starting next month due to some tightness in the money markets. A lot of people already are talking about quantitative easing, etc., etc. I don't think we're there yet, but this is definitely a step towards that. Mortgage-backed asset runoff will continue at $35 billion per month. The Fed did acknowledge increased uncertainty in the economic outlook. The Fed is in no hurry to change interest rates. Now, they did change a couple of things here with regards to their projections. So 2025 GDP forecast has been lowered from 2.1% to 1.7% with slight downward revisions for 2026 and 2027. 2025 core PC inflation projection increased from 2.5 to 2.8%, primarily due to tariff risk, but 2026-2027 projections remain unchanged. And this was basically also one of the main points which we're going to touch on here. tariffs are expected to have a temporary, not structural inflationary impact. So here we're going back to the transitory type of wording, right? Previously, inflation was transitory. It was not. And now maybe the impact of tariffs might be transitory as well. Remains to be seen, right? Remains to be seen. But I do sense that the Fed does not want to make the same mistake it did previously. Previously, it did not have to stimulate the market and create even more inflation. They should have looked at the real-time data and seen that the economy did already rebound. It didn't need another injection of $1 trillion or something like that, which has caused even further damage and even more inflation. By the way, if you look at the consumer sentiment surveys and all of that, again, as we've spoken here about in past videos, a lot of those surveys are politically motivated. And Jerome Powell even said that, like, you're getting answers from survey consumer sentiment that are extremely bad. But then if you look at the other side of the data, you can see that people are still buying new cars. So which one is it? Going back here to the next points, 2025 unemployment rate projection slightly increased from 4.3 to 4.4%. The Fed still projects 2 rate cuts in 2025. The federal layoffs are having a negligible effect on the national hiring data, and consumer spending is slowing but remain resilient. This is something that we've heard not only from cruise lines, by the way, when they talk about their future bookings, but we've heard that from some banks, we've heard that from card companies as well. So yeah, currently those that like to use the word recession, I think they might also be quite politically motivated to do so. But to be honest, right now, the data just does not indicate a super high probability of a recession. Is there a probability of a recession? Yeah, just like always. And maybe, yes, with these tariffs, maybe it is a bit higher than previously. But it's not like, 90% chance of a recession. I don't think so. Now, moving on to something more interesting. The Google acquisition of Whiz. So this is a great infographic by Software Analysis on X, great account to follow. So as you can see, Whiz alone is more than all the Google acquisitions of the past. If you look at all the Google acquisitions of the past, $31 billion, Whiz alone, $32 billion. Now, here he shows us another very interesting infographic. So the future of cloud security. You've got Google, Whiz. Google has the Google Cloud products here, which has Google Threat Intelligence, Security Operations, Command Center, and then Mandiant Consulting Services. By the way, this was also a company they acquired for $5.4 billion. But then when you combine Google and Whiz, you got AI plus cloud. This is what Whiz provides you. Again, I've talked about that in another video. And then you've got the frenemies. Why is it frenemies? Because, believe it or not, because Whiz is working with multi-cloud. So they're working with the AWS, the Azures, the Oracle. So yes, the competition for Google are now also going to be their clients. And I don't think that will change. I think that's exactly why they wanted to buy Whiz. And then, yes, and then you have the competitors, the CrowdStrike, the Palo Altos, the Zscaler, SentinelOne, and all of those. It's a very interesting acquisition, not cheap, but I think extremely important and one of the ways for Google to compete with the likes of Azure and AWS. I think, again, if it goes through, because this deal will only close maybe 12 months from now, if it gets approved, of course. If it doesn't, they'll pay a 10% penalty fee. So that's $3.2 billion that they have to pay to Whiz. That's going to hurt if that happens. Moving on to comments from the great Warren Buffett.
Stocks are down today, and I'm buying more of something I was buying yesterday. I'm buying it cheaper. Now, when you go to the grocery store and you buy something cheaper than you bought it the day before, you think that's terrific. But people with their stocks, they think that the stock knows more than they do. So that when the stock goes down, they say the stock is telling them something, and what's telling me is I can get more for my money. but they take it as kind of a referendum on themselves, and it's me versus the stock. If it ever gets back to what I paid, I'm going to sell it. The stock doesn't care what you paid. You have to remember, the stock doesn't even care that you own it. You are nothing to the stock. That stock is everything to you, And you remember you paid $10.13, and therefore the stock should get to $10.13 before you sell it. the stock has no feelings about you. I hate to disillusion you on this, but it just doesn't care. And so the only question with every stock, every day, and you don't do it this frequently, is...
Before we continue to the second part of this clip, which is also very important, this is again, I mean, Peter Lynch did talk about that as well. The stock doesn't know that you own it. The stock doesn't know that you want it to go back to the price that you bought, and so you could sell it at break even and not lose money. The stock doesn't care about your portfolio, right? The Wall Street doesn't care about your portfolio either. You care about your stock. You care about your portfolio. So yes, he says here, the stock being down or stock being up doesn't really tell you much. Yeah, usually in the longer term, if a stock goes up, that means the business has been performing well. But in the short term, a stock going up does not always mean that suddenly something drastically has changed with the business. It has increased by 100%, margins are at 90%, etc., etc. And the same when a stock goes down in the short run, right? Suddenly everybody's starting to ask questions. Everybody becomes a philosopher, right? You found the philosopher's stone and suddenly you become like, wow, actually it came down because it was expected to rain, it didn't rain, and then this guy owed me money and it affected the stock market and my emotions were all over the place and that's why it's down. No, it's a load of BS. Yeah, it's a load of BS. No, it can go down because the market wants to take stocks down. It can go up because the stock market wants to take stocks up. These things happen. Your goal is to focus on the business. Is the business that I own worth it for me? Am I paying for a good business? And is my money put to good use? Does my return on my investment still look very attractive compared to what I could be buying next door? Next door meaning the same stock market, but you get what I'm saying. And this is what he's going to explain in the second part.
The only question with every stock, every day, and you don't do it this frequently, is can I get more for my money someplace else? You've got a chance to be in thousands and thousands of great businesses, and their prices change all the time, so their relative valuations change. And you can make the exchange at very low cost these days. Commissions are nothing. So you can always shift from one business to another. You have a huge advantage over Andrew Carnegie. You know, when he was in the steel business, or Rockefeller was in the oil business. He could not shift over immediately to retailing or something like that. You can rearrange your business empire, which you own through that little portfolio that you have. You can rearrange that, at a moment's notice with practically no cost. It's a huge advantage, which people turn into a disadvantage. There is nothing about the price action of the stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
It's pretty simple, no? It's pretty simple, and that's why I wanted to show this clip, and that's why I said what I said at the start of this video, talking about, well, maybe replacing some of the stocks at the bottom of that portfolio. And that's why I have been replacing stocks in that portfolio. That's why I've been replacing stocks in my core portfolio as well, since I started investing in 2016. Because yes, sometimes when you open up a position, stock A, the one that you just bought, looks very attractive. Yeah. Stock B, we don't know which one that will be, but stock B, you say, anonymous stock, it's too expensive at the moment, right? Let's say 6 months from now, stock A, the business is doing okay, but nothing more than that. Stock B, suddenly stock B's stock price is down 40% because there is a market correction, but that business looks way more attractive to you. You're like, oh, at this price, I actually like that company much more than I do stock A. And so yes, we as investors, retail investor, we have the luxury of doing the switcheroo, right? You sell stock A, you buy stock B. Stock A, thank you very much, goodbye. The stock, as we've said, doesn't know we own it, so you're not marrying a stock, you're dating the stock. You dump it and you go to something much better, which is stock B, because the price has suddenly become much more attractive. You're putting your money in a company where you think that that company will take care of your dollars much better than the other one. You're looking for the best return on investment. And so yes, as you will see, and as you've seen in the past, I sometimes make changes. I talk about a company, I'm quite bullish on that company. But yes, if another opportunity arises where I think, oh, my upside in that company at today's price, thanks to a small correction, might actually be bigger than the other one, then of course I will change it. Why not? In the past, I've made those mistakes. I've made those mistakes where, oh, I bought already this stock, right? I already bought it. It's in my portfolio. I can't sell it, right? I can't sell it. Even though I like the other stock, I just can't sell it. And now I'm thinking about it and I'm like, why? Like, again, the stock doesn't know that you own it. He doesn't care. Sell it, buy it, trade it. He doesn't care. It's a vehicle. It's a trading vehicle for you to get more wealthy in the future and, well, enjoy life later on, right? So yeah, going forward, I don't mind. If I see an opportunity and I think, oh, actually this company is way more interesting than the one that I own, thank you very much. I appreciate your service, but this one is much better. And that's it. And then maybe in the future, that company might be replaced with something else. Why? Because why do we invest, right? Why do we invest? Because we like all of this? Yeah, maybe, yeah, we like it. But I invest because I want to retire early, I want to live a good life, I want to take care of my family and friends if I can. That's it. So if I can reach that point faster by changing those companies because I like other companies, because those are good businesses, then of course I'll do it. Of course I'll do it. That doesn't mean I'm going to trade these names each and every day. No. But 6 months, a year, 2 years, whatever. Sometimes, yeah, I can change and I can look at better opportunities. The grass is not always greener, but sometimes it is. Sometimes it is. So, all in all, that's about it. Pretty long episode, but I think it's a pretty good one, if I do say so myself. If you enjoy it, share your comments, hit the like button, subscribe, do all of that. Would really appreciate that. Check out FinChat. Link is down in the description and the pinned comment, 15% off. And I'll see you all in the next one. Bye-bye.